Good afternoon, everyone, and welcome to today's webinar on strategic deal making. Thank you for being with us today as we unpack one of the most pivotal factors in business success, understanding what truly captures an investor's interest. I'm Chani Halai, and I'll be your moderator today. Strategic deal making goes beyond just numbers. It's about vision, timing, building relationships, and confidently navigating complexity. Today's session is crafted to equip you with actionable insights, real-world perspectives, and strategies you can put into practice. As we wait for everyone to join in, I'd like to request you all to type in your name, the organization you represent, and where you're tuning in from. Thank you. Thank you, Manawar, Murali, Frederick, thank you for joining us. Thank you, Mitesh, for joining us. Thank you, Nikhil, Ajay, Frederick, Varaha. Okay, before we get started, let's go over a few quick housekeeping details. Please submit your questions at any time using the Q&A tab, and we will address them towards the end. For any other questions, please use the regular chat. This webinar is being recorded, and we will upload the recording on our YouTube channel, Video East Africa, where we have over 50 webinar recordings from our previous webinars. With that, let's turn our attention to today's discussion. The agenda for today is types of investors, what investors look for in a business, and financing instruments. Now, I'd like to introduce our speakers, starting with Deepa Doshi. Deepa is the partner for Deals Advisory at BDO East Africa and represents Kenya in the Manufacturing Africa Initiative. She is a finance expert with over 3 decades of experience in corporate finance, transaction advisory, risk, and compliance. Her experience spans across various sectors, ranging from financial services and manufacturing to healthcare and real estate, and has supported several high-profile merger and acquisition transactions across East Africa. Her career highlights include a key role in investment banking at Stanbic Bank Kenya, and a historic achievement as the first female partner at BDO East Africa's office in Kenya. Deepa holds a degree in banking and international finance from City University London and is both an ICAEW fellow and a certified public accountant. In addition to her corporate roles, she serves as a non-executive director at Mayfair Insurance, and is actively involved in philanthropic leadership, including with Aga Khan Health Services Kenya. Our next speaker is Sarjan Shah. Sarjan is the Director for Deals Advisory at BDO East Africa and brings over 8 years of experience in corporate finance and investments. He is a CFA charter holder and a member of ICIFA. He began his career in 2015 with Grant Thornton, contributing to the establishment of the firm's corporate finance division in Kenya. Prior to joining BDO, he worked at the Facility for Energy Inclusion, a private debt fund managed by Lionshead Global Partners and funded by global DFIs, with the primary focus on small to medium-scale renewable energy projects across sub-Saharan Africa. At BDO, Sarjan plays a vital role in driving capital raising efforts and providing strategic transaction advisory services. With strong expertise in financial modeling, valuations, and investment materials, he helps businesses structure deals and engages the right investors. His experience in managing complex mergers and acquisition transactions and conducting financial due diligence ensures seamless execution and informed decision-making. Our next speaker is Vincent Wambui. Vincent is currently a senior associate in the Corporate Finance and Transaction Advisory Department at BDO East Africa in Kenya. Vincent brings over a decade of diverse experience across financial advisory, project consulting, and commercial banking, with a strong focus on managing relationships with high net worth clients and advising on both local and international fixed income investments. He is a finance professional with proven expertise in financial modeling, business valuations, and financial due diligence. His work involves analyzing complex financial data to support strategic decision-making and evaluating business performances and value, and assessing risks and opportunities in transactions. With that, I'd now like to hand it over to Zahir Sheikh to introduce BDO East Africa. Thank you.
Thanks, Chandni, and a very warm welcome to all of the participants. How many? We've got 114 participants. That's a good number for me. Same number as the chapters in the Quran, 114. So welcome to all of you. Let me start by introducing BDO. Many of you know BDO, and for you, this is going to be a repetition. So please bear with me. For those of you who are new here, BDO is a global audit and advisory consulting practice. We're the 5th largest globally, with a presence in 166 countries and territories. We have over 1,800 offices globally and nearly 120,000 professional staff worldwide. Our turnovers in our last financial year exceeded 15 billion US dollars. So we have a reasonable size and a global footprint. Next slide, please. So this is a little bit about Deals Advisory. Deals Advisory, let me tell you, is something BDO is very proud of. We've been number one, okay, in terms of the deals advisory space for a number of years. And what I mean by this is the number of deals. Okay, and you can see there, the rankings that we've had, but essentially not the value, but the number of deals. And just in last year, we completed 1,752 deals in deals advisory. What this means for us is our clients and our partners trust us. They trust us to take them over the line. And this is really important because when you're doing a deal, a lot is at stake, not just your own reputation, but also your finances, as well as the reputation of the two companies that are coming together. So a lot is at stake, and you only want to be dealing with people, who are confident and can take you across the finish line. So basically, you can see last year we provided these services in 115 countries. We have 2,500 dedicated corporate finance professionals working across all of our borders, and 42% of all of those deals involved private equity. Next slide, please. This is a little bit about our footprint here in Africa. We have a growing footprint in Africa. You can see we have a presence in all of those countries. We're talking Kenya, Uganda, Tanzania, Rwanda, Burundi, DRC, as well as Ethiopia. And we're going to expand our presence in a couple of other countries as well. We have physical offices in all of these countries, and I think we're unique. We're unique because we have one partnership. So what this means is one agreement that all the partners sign to, which means we make decisions as one body across all of these countries, not individually in each country. And what this means for us is number one, we have the same systems. We're able to much better train over all of our people because we provide standardized training across all of the countries. We're able to carry all of the countries along, and we're able to provide a seamless service across all of these countries because we're able to share resources and respond to our clients' needs on an almost immediate basis. So I think BDO is uniquely has a unique opportunity here in this particular market to serve our clients. And for those of you who haven't tried our services, I'd very much urge you to get in contact with myself or Sandeep Kapre or any one of our managing partners in any of our countries. Just go to the BDO website and we would be very happy to talk to you. Next slide, please. A little bit about our services now. So I basically am the regional head of advisory services. So I'll talk a little bit about that and then briefly about the other services. So within advisory services in these countries, as well as globally, we provide internal audit and risk management. And internal audit, we also provide it as an outsourced service. So what this means is if you don't want to have your own internal audit department and you want to outsource the service entirely to BDO, we can come in, we can do your internal audits, we can do all of your checks across all of your departments, and we do this by coming once every quarter, so 4 times a year. And the advantage of doing this through a firm such as BDO is number one, you have huge savings of up to 50 to 75% of your current costs, compliance costs, just for internal audit. And the other big advantage is you have a global brand, which means you have the latest training, you have cutting edge technology, you have resources that have industry expertise and cutting across various industries as well. And we also employ the latest data analytical and AI tools. So we give you fantastic value for money. And then we have a corporate recovery division, which is a business turnaround division. So these are your corporate doctors. You know, when you have a sick patient, we can basically diagnose what the illness is and then provide the right treatment for it. This webinar is sponsored by Corporate Finance and Transaction Advisory Services. So that's your deal advisory team, which is Deepa, Sajid, and Vincent. And you're going to see them in action soon. And then I also had the forensic investigations department, which is where we do fraud investigations. We respond to any sort of crime in your organizations, any sort of misconduct. And we can also provide things like whistleblowing hotlines and also fraud detection and fraud prevention services. And then we have a technology advisory division, which provides a whole range of IT audit services, technology advisory services, as well as things like cybersecurity and data protection services. And finally, we have a ESG department or division, which provides services on environment, social governance, climate financing, green financing, and so on and so forth. And again, please speak to us and we can look after you in that regard as well. A little bit about our audit and assurance division. We provide statutory audits. These are the normal audits of accounts where we provide signed accounts and an opinion. We also do audit of special projects such as donor-funded projects or special purpose audits. We provide training not just in the advisory services such as this training, but also other IFRS training and other technical training to basically improve the quality of the audit as well as the assurance services that we provide. We have a very strong tax division which provides two basic services. One, compliance. So this is filing your returns, payroll, VAT, and so on and so forth. And the second one is advisory. So in the advisory services, we provide tax reviews, we can do a tax audit, a tax health check. We provide transfer pricing advice on international transfer pricing and what is the implication of that. We also provide advice on employment taxes, expatriate taxation, how to plan your taxes on a corporate level, as well as dealing with the revenue authorities. And we actually have a very good track record when it comes to dealing with revenue authorities. And we've actually been able to bring down claims that are brought about by the revenue authorities significantly, because we believe we have a very strong team that has perfected, if I can use that word, the art of gathering the evidence and then providing it in a manner which satisfies the tax opinions as to the claims that we're putting forward. And finally, we have our business services and outsourcing division. And this basically provides all kinds of outsourced services. So whether it's accounting and bookkeeping, whether it's compiling your annual statutory reports, or providing management reporting, creating dashboards for you, using AI to create dashboards, providing financial management agent services, fiscal management services, doing your payroll for you, as well as company secretarial services, legal services, and so on and so forth. So a little bit about BDO there. What I'd like to do is hand you over to the presenters and to welcome you to today's session, which I'm hoping you'll find very, very exciting and challenging. Thank you, folks, and have a wonderful event.
Thank you, Zahir, for the introduction. I'd now like to hand it over to Vincent, who will kickstart the discussion. Thank you.
All right. Thank you. All right, thank you. Yeah, sticking to our strategic deal making, when now it comes to the investment ecosystem, we have various players. One of them is investors, the other is investee companies, and the others are now transaction advisors. But now sticking to our today's webinar theme, we are going to look at the types of investors operating in our markets. And we have various, or the most prominent are venture capital, who are commonly known as VCs. We have private equity funds, commonly referred to as PEs. We have impact investors and development finance institutions known as, or as in commonly referred to as, DFIs. So each of the investors, they differ in terms of their criteria. So going on to the next slide, one of the criteria that differentiates them is their priority, their ticket size, sector preference or focus, investment horizon, and the return expectation. For the capital, for the venture capitalists or VCs, these are your early capital providers. They usually seek ventures with extremely high growth potentials, or basically startups. And their tickets range, they can range from as low as 50,000 US dollars to about $5 million. And they usually prefer tech-based sectors or innovation-based sectors. These are sectors that generally provide or promise high growth prospects. And the investment horizon is usually long-term, and they usually provide financing in form of equity funding. And basically, their return expectations are high to super abnormal profits or returns at the end of their investment horizon. They usually exit. They don't have a definite investment horizon. They usually exit when they feel that their return expectations have been met. For the private equity funds or PEs, these are funds that usually provide financing to already established businesses or high growth companies that have a proven track record in terms of revenue. And you will find them providing financing ranging from $5 million to about $50 million. These are for the PEs operating in this region of the global south. And some of them are sector agnostic. They can go to as many, they can invest to businesses operating in different sectors, while some are sector specific. You will find will not invest in businesses that produce cigarettes or alcoholic beverage or maybe guns or any other product that has harmful effect on the population. In terms of PE's investment horizon, it usually ranges from 7 years, 5 years to 7 years, because they are chasing some sort of defined return. And their return expectations usually will be 3 times their invested money. For example, if they've invested $10 million, they will come into the business, help in terms of strategic expertise, grow the business, and exit down the line, maybe 5 to 7 years, when their value of the portfolio has grown to about $30 million. Another important type of investor that is usually found in this the global south are impact investors. And these are investors who will provide financing to businesses that are aligned to a specific social objective. And one of the social objectives would be probably, let's say, gender diversity, climate, and or even job creation, especially for businesses located in the global south or basically or typically in the sub-Saharan Africa. They provide financing in various ticket sizes. Usually, they don't have a defined ticket size. You will find them providing, let's say, grants, $5,000, 10,000 US dollars, or even as high as $1 million. However, they are sector specific because they are providing financing to businesses that are aligned to some social objective. And the investment horizon typically is medium term to long term. Basically, should go 5 years and above, and they usually seek a return expectation of 10 to 15% of the investment horizon. The other category of investors are development finance institutions, and mostly are found in the global south because of the development issues we usually found in the global south, and they usually finance businesses that are aligned to their development goals. And since they are backed by respective governments or even other institutions, they will usually provide higher tickets. And typically ranges in 5 million, 10 million, and probably to $50 million because of the sizes of companies based in this market. They are also sector specific because they usually focus on businesses that are aligned to their development objectives, and they are able to provide long-term financing other than or compared to our normal commercial banks. So those are the most common types of investors you'll find in the global south. And some of the examples or some of the names you will find in these markets are starting with venture capital, especially here in Kenya, you find Chandaria Capital. They provide seed funding and in various multiples, and you will find IDF Capital. For private equity fund, you will find Africa Invest, a very big private equity fund operating in sub-Saharan Africa and North Africa, and also Adenia, operating in Eastern and Central Africa. For impact investors, since they are providing financing to businesses aligned to some social objectives, you will find the names like Novastar Ventures, DOB Equity, and Blue Orchard, or even Bamboo Capital Partners. For DFIs, we have Norfund, IFC, which is an arm of World Bank, and DFC, which is an arm of the US International Development Component. So what do these investors provide? They usually invest in businesses in various, or using various financing instruments, and they will provide equity financing, debt financing, or a hybrid of or a special kind of a financing instrument with debt and equity features called mezzanine financing. So for the debt financing, this is a form of financing that comes with a repayment schedule, either monthly, quarterly, or yearly. And in most cases, since these investors provide patient capital, you will find that they're providing debt that has a repayment schedule of either quarterly, semi-annually, or annually in the most extreme cases. And you will find some providing debt with some what you call a deferred time. They give you a grace period of about 2 years for the business to absorb the money, start generating earnings, and meeting their repayments. So another component or another feature that comes with debt is there is no ownership of dilution. If you are a business and you don't want to give up ownership of your business, so the best, I think, instrument to go for is debt. However, there is also a downside to it, because in as much as you're looking for debt and avoiding to dilute the ownership, you also need to consider what is the interest rate, what are the terms of that debt. So another feature that comes with debt is there are no voting rights. So that comes now with various covenants or restrictions in terms of how the business should maintain its earnings. And probably another covenant will be if the company is being sold, the debt has to be repaid. One of the advantages of using debt to businesses, or if you are a business person or a business or an entrepreneur, one of the advantages is the tax deductibility of interest payments. Interest payments are always paid before taxes. Another advantage will be you have a predictable repayment schedule. If maybe you've been provided debt by a DFI, they usually give a grace period, in most cases a grace period of 2 years. That gives you as an entrepreneur time to absorb the money and start generating earnings, and the business will have stable earnings. So the downside for the debt is that if you take on more debt, there is increased chances of bankruptcy, and in most cases, it's always good when you are raising debt, ensure it's optimal. So another type of financing provided by investors is mezzanine financing, and it's a hybrid. It's a component that combines debt and equity features. In this context, be provided with financing in form of debt, but if in the likelihood that the company does well, there is that covenant whereby or that allowance whereby the debt providers can convert to equity, so that now they can enjoy in the equity upside of the business. So its advantages is it's flexible. It allows the companies to access capital without diluting ownership. And it's again flexible because less collateral is required compared to your normal traditional loan or debt. However, it has its downside. It carries a higher interest compared to debt. And in case whereby the mezzanine financiers decide to convert to equity, it's going to result to dilution of ownership. The other financing instrument that usually investors provide is equity. And with this now, it's a form of ownership where now you're selling or you're providing or you're selling the ownership of the company to investors. And it comes with voting rights on decision making, as well as sharing of profit and losses, as well as equity dilution. And one of the advantages, it's very flexible and requires no regular repayment like debt. And it's always better for long-term growth. And it's usually preferred by startups. These are companies that have no revenue record. However, when it comes to downside, it's always expensive because equity investors usually expect a higher rate of return because they are offering their money in return for an equity ownership. And when the company post losses, they're going to share in the losses. That is why they usually expect a higher rate of return. The other downside is that it dilutes existing shareholders, especially for new uh, for new investors coming in. Also some investors comes with new terms and conditions in terms of management and decision making. I will hand over to Sergeant to take you through the next slides about what investors now look for in a business. Thank you.
Hi, everyone. I think I'm going to be the new sergeant. So in terms of what do investors look for in a business or a venture when they're looking to invest, I think first and foremost, it's the people. It's the people that drive the business, that own the business, and that's what investors look for. Deal making is primarily about people. So in terms of shareholders, what is their commitment? Are they hungry to grow and drive the business? What are their ethics? What is the moral fiber of the business that forms the backbone of the company? Management, what is the knowledge of the management for the product in the market, in that sector? What kind of distribution networks do they have? Relationships do they hold with their suppliers, with their customers? That kind of knowledge is very important as well. What is the experience? And what is their previous experience at running or leading companies, ownership and success of investments that they've held? What is the track record? Have they succeeded, or are they sort of fly-by-night type of investors, type of company owners? So that is very important. In terms of skill set, what do they bring to the table? Operational, financial skills, sales. So do you have your dream team in place? Even if it's an early start, at least in skeleton terms, the dream team must be in place. You have a strong finance function, a good sales team, technical ability of the team that's involved in the production and the manufacturing. So what are those building blocks of that business? Qualifications, do the team have relevant qualification? This is particularly important in regulated industries like banking, financial services, insurance. Do you have the right kind of people in place? Even in TMT, pharma, people with technical knowledge, experience, expertise that are able to drive the organization. Next slide. Next slide, Johnny.
Hi,
Sorry. Okay. The second factor that a lot of investors will look at are the market opportunities. So given you've got assurance of the people that you're going to transact with, what is the market opportunity? Do the macroeconomics and the demographics support that opportunity? What are the macro trends? And the growing population, consumer goods will move fast. So, the appetite for consumer goods will be high. What is the economic and political climate within the country? Does it support investment? And it's not just about investment in. Once you've invested, does that economic and political climate support you to continue holding that investment, to continue nurturing that investment? What other relevant demographics can you look at? Like, is protein consumption, for example, on the increase? Other factors like education, if it's a company that's involved in training and education, is that in demand? Is that growing? So the macroeconomic and demographics form sort of fundamental as to why an investor would want to enter that particular business. Secondly, what is the current market, the size of it, who are the players, is it an oligopoly or is there a monopoly, is it going to be difficult to break in, what is the landscape, how competitive is it going to be a price war? Those kind of factors drive someone into coming into the business. And then looking at the SWOT analysis, so strengths and weaknesses, what are the opportunities, what are the threats of that business, and for someone who's preparing to attract investors, it's good to know your own profile of your strengths and what are your weaknesses. If you have weaknesses, it's good to know them. It's good to have mitigations against your weaknesses. Try to prepare for addressing the weaknesses. And if there are threats, then what are you doing about those threats? How are you staying on top of your game? In terms of market outlook, how does that growth look like in the market? So, and what would happen in the next 3 to 5 years in that sector? I think more and more, for example, in the technological advancement scenario that we find ourselves in, often opportunities are very binary. Today they're there, tomorrow they're not there. For example, Kodak, you know, once upon a time, a large organization. Today, you know, with the digital cameras and all, then physical pictures have taken a back step. So, and that technological and advancement is very exponential. So to that extent, how does that market outlook look like? Can you predict beyond your 3 or 5 year investment horizon? How does it look for you when you potentially want to exit? How will that look? So investors also consider those kind of things. So the more you know about the future of the sector you're in or can predict, the better you're able to attract the right kind of investors. The specific niche or segment that the company is operating in, what are the nuances of that segment? And how well do you know those nuances? How well do you play them? How well do you position your company to take care of that niche? Are you a leader in that niche? Are you a follower? Are you addressing the tail end of that particular curve? And the tail end sometimes can be quite big as well, because then it's a volumes game. So where are you positioning yourself in that specific niche or segment? What are the support structures that you have? So what are the barriers to entry? And there, I think tariffs play a big role. Are there tariffs in that sector whereby an early startup or someone who's already been in that business for a while has an advantage, a competitive advantage, because they are well established? A newcomer may take much longer to gain scale, gain speed. KRA, for example, plays a big role in the import duties that they put on particular products. And for how long would that protection be there? So those are the factors that investors often look at. Next slide. The other aspect, and a platform, in fact, so once you've gone through the people aspect, you're a good fit, you've gone through the market opportunity, the opportunity exists, then the next factor that investors often look for is, what is the existing balance sheet looking like? Has there been a successful track record for at least the last 3 to 5 years? Is revenue generation is important. Operating profitability is also important. And if you can also then have a net positive EBITDA or net profit margin, then that makes the business even more attractive. And a track record of 3 to 5 years at a minimum, but a longer track record of successful company is always welcome. Operational stability. So, you know, what are the working capital ratios looking like? What sort of operational efficiencies have you built into the business? The strength of the operations team. How well do they know what they're doing? Is there continuous improvement processes being driven? Just-in-time policies being followed for stock and replenishment, manufacturing? What are the leverageable assets? Is there an existing brand that can be upscaled, that can be banked on? What does the distribution network look like? Supplier relationships, are they existing? Are you having to look for new suppliers each time? Are they able to give you better credit facilities because of your existing relationship? And buyers, who are your customers? Do you have customers that are servicing um, their part well? Are they paying on time? So those kind of factors are important. What is the financial capacity of the existing balance sheet? Is it over leveraged? Do you have proper working capital financing? Are you balancing long-term and short-term assets versus your liabilities? So not using overdraft to finance a building, all right? So those kind of factors, the financial health is important. So existing capacity of debt and future capacity of debt. That's also important. Are you able to take on additional debt? Are you able to take on additional mezz finance? And resource commitment. Are you committed to your people? What kind of training are you doing? How much money and time is being spent by existing shareholders and management in the business? Is there real commitment? And that's what people look for as well. Next slide. So having looked at the existing health of the balance sheet, the next step is to look at what are the forecasts for this particular business. Is there a good revenue forecast? And are the assumptions realistic? Is the growth profile really are you able to achieve it? Is it reasonable? Or is it over optimistic? And it's always good to look at your own business and kind of play out 3 scenarios. Work on your base case. What would be the ideal growth strategy? What would be your future? Can you have like accelerated growth? What is the return on investment looking like in a situation of accelerated growth, in a situation of base case? If the economy was to turn down, what does that look like? Does it meet the minimum benchmark return on investment if things were to turn down? Secured contracts. Do you have contracts in place for your suppliers? With your suppliers, do you have contracts in place for buyers? This is particularly important for agri-processing businesses. Are there buyers on the other end that are always willing to take on whatever you produce? Revenue generation experience. So we spoke about that a little bit earlier. So again, the team in place, are they able to take it to the next level? Or do you need to bring in an additional resource? Do you need to bring in additional people with knowledge and experience to take you to the next level? So the current dream team may need a little bit of change to move you to the next level. And then the shareholder equity investments. How much money has already been invested? Can the shareholders inject further equity alongside debt to maintain the correct debt equity ratio? And we'll look at the gearing a little bit later. So those kind of aspects are important. And on that note, I'll ask Sarjan to just look at sort of the growth curve and how that growth curve of the company matches where we are in terms of the financial profile of the business and the forecasts looking forward. Thanks.
Thanks, Deepa. Good afternoon. Pleasure to be on online chatting on this. So yes, I mean, Deepa has mentioned on the revenue profile and the requirements of credible forecast of revenue. If you see a typical business cycle, you'd always see a J curve from the startups that are now growing to the second phase and up to reaching maturity. Up to maturity, and there's a point at the business could decline or could expand further. As Vincent had introduced all the different types of funding partners that are available within this market, you can see where each of those type of players would fit in at this curve for the business cycle. VCs at the start, P is going in the middle. At the growth phase, you could have additional VC funding at that point as well. And then obviously move into more higher ticket sizes where the business is now becoming mature, revenues are plateauing, and you're looking at who do we bring in at that point in time. And the key point I want to highlight is at the maturity phase, where we are now looking at stabilized revenues, a unclear path to growth, and so you decide you bring in a PE to support your current business and possibly try and strategize to grow it further, or you bring in a strategic partner that will help you now move on to this next phase, so you can try to avoid that decline that we have seen on the last step. So what that means is, with strategic partner coming on board, you're now trying to look at a quantum of market diversification or product diversification. And this is where a strategic investor will come in to say, do I see, and this is where we fit in all the previous slides that you just mentioned on market outlook, what are the market opportunities, and that is where a strategic investor possibly comes in, says, okay, this is where we see an opportunity, either in a market diversification by moving into by moving or expanding beyond your current region, or you're looking at it as a product diversification. Within the product diversification, there are also two ways of looking at it, either vertically or horizontally. When I mean vertically is across the value chain. Is there an opportunity to diversify our revenue streams across the value chain, or do we go horizontally and work out with complementary products or completely new set of business tools? And this is where I believe a lot of financing acumen comes into play, because it will always be better to, or if you do want an aggressive growth strategy going forward, a lot of the strategic investments would be based on future acquisitions of already existing businesses in the diversified revenue streams, either in different markets or across different product lines. Next slide, please. Let's move on to profitability, and I'm sure everyone has heard of all these profitability terms, and what investors are actually looking is at some of these items. But while everyone knows people look at profitability, I think the clear idea of this slide and what we want to bring out is, why do they look at this profitability, and how does it tie to what they're actually trying to search in a business that they're looking to invest in? So we do have our typical gross profits, EBITDAs, profit before tax, net income. But if I bring you to the knowledge of DuPont analysis and how an investor or an equity investor looks at return on equity, he's trying to understand what sections of the business or what part of the business in terms of financial statements is providing the necessary returns that are being shown on the books. So if you look at just a three-step DuPont analysis, I mean, there's a 5-step and there's a 7-step, but let's just focus on the 3-step model. And the 3-step model first starts with you looking at your operating margins. Typically, we'd be looking at your EBITDA margins, because that is showing you what part that your operational efficiencies are what are providing you with those higher returns in your return on equity formula. And apologies if I'm going a little bit more technical, but we try to understand what an investor is actually looking at in terms of his return on investment. And if I tie this profit and loss statement back to our balance sheet, you'll see that the investors are also looking at understanding how the sales turnover is, as opposed to the assets that are being used. And this is where we get to what we call the asset turnover part, which is also another component for the return on equity. So they're trying to understand how assets are efficiently used to provide the sales that are needed to generate the efficient operating margins. Can we move to the next slide, please? So we've talked about the balance sheet, we've talked about the income statement that are being reviewed by investors, but at the end of it all, the cash flow statement is very important, and I'd like to highlight the quote that is being put there: cash is king. So now the cash flow statement and your profit and loss, your balance sheet have already allowed you to understand your short-term goals versus long-term goals, and how do you balance this from a cash flow perspective. First things investors are trying to understand is, does your cash flow from operations actually tie very closely with your EBITDA numbers? Why do I say EBITDA numbers? Because in your cash flow from operations, it is only looking at how you're operating the business from a collection point of view and a spend point of view. So you're earning revenue in cash, and you're obviously clearing your debtors or your suppliers in that perspective. And if you look at the EBITDA version, it pretty much says, okay, yes, these are my products, this is how I bought them, this is how I sold them, and these are the supporting factors that allowed me to sell them. And that is clearly what is quite close to your cash flow from operations. There are instances where you'll see that this does not match, and your EBITDA is maybe very profitable, but you're on negative cash flow from operations. And clearly that's a clear sign to investors that there's a problem with the working capital management systems. Either you're paying off your suppliers too early and collecting cash too late, or you're holding too much inventory, and this then becomes an issue for an investor, saying that there's something that's misaligned. Another thing that could pop up, and what an investor may end up assuming, is that the books or the revenue recognition or the accounting entries have, or how accounting has been done is not reflective of what is actually happening in the business. Again, a sense of reason why companies would do a due diligence to ensure that the correct recognition methods are used in the accounts or in the P&L that tally with your cash flow statement. So again, going down a cash flow, a typical cash flow statements, I've got up to the point of talking about cash flow from operations. Right below cash flow from operations is what we're calling cash flow from investments. That is the place where you understand what the business has done for capital expansion purposes. If there's significant enough of cash flow from operations, a business could have been growing by bootstrapping its own cash, which is always a good sign for an investor, knowing that a company is able to use that cash or use those assets to generate the right amount of cash, and so they understand that the return on the asset is quite significant, and they're able to continue bootstrapping going forward. Or is it a case that there is a requirement for capital injection to continue with the investments and maintaining the business operations, maintaining the assets that a company holds, and is that something that is required? And so when an investor is looking at it from a growth plan, he's trying to understand, is this company, if I put in money right now, is the company able to wisely use my money to get the right assets to generate the right profitability for me to continue operating this business and showing that growth on my returns? So that moves us now to the part, which is what you call cash flow from financing. So, and that allows us to ensure, is the capital sustainable? Is the capital structure the right way? Once you've gone through the operations, gone through the investments, you do require some financing to provide back to your lenders or your debt providers, or your equity holders in the form of dividends. And is that able to generate the right returns? So, is your cash flow from operations and investments then allowing you to generate the right return on invested capital? So again, is it a case, and this is where we'll say, if we continue seeing additional debt being put in, it becomes a red signal for quite a few of the investors. And if that additional capital within the financing is not quite matching with the investments you're making, then what is the extra financing being acquired for? Is it now to repay, or is it just restructuring or refinancing the previous your previous debt, the obligations, or not? Can we move to the next slide, please? Yeah, so we mentioned about gearing, and Deepa did talk about gearing and how leverage works. I'm not going to go through the basics of what we mean by gearing, but everyone knows this is the amount of debt you take on board as opposed to your equity and other sort of capital investments. And everyone knows the impact of what leverage does, and how our three financial statements, as I mentioned, affect how much debt can be then taken on board. So you can see that the lower the profitability, the harder it is to take on debt. You'll not be able to service those obligations, and then investors therefore looking at, is there ability for me to provide additional debt for this business so that it can sustain itself? Or is it a case that I restructure or help the business restructure, come in with some form of equity and some form of debt, or do I need to come in completely as an equity holder, and how that impacts the dilution of the shares and probably future profitability as well? But the idea of looking at some of the gearing, and if I take us back to Modigliani and Miller, back for my school days, there's a part where they mention uh, there's a right amount of gearing that is required. And this is, again, very subjective to different sectors. Every sector would have a different leverage requirement. If I'm looking at an infrastructure real estate project, definitely I'm going to have much more debt on my books as opposed to equity. But then if I look at some of the other businesses that you're looking at, you typically see that the equity amount needs to be slightly higher, and then that slightly higher possibly does not have to be more than 50%, but it is higher than your usual heavily debted business sectors. And going back to the theory, and it mentions there's a curve within the capital structure that gives you the right sort of leverage, and investors trying to understand what's the right amount of leverage this business can hold, and that basically, again, what it does is lowers your cost of capital, increasing the value of a business. That being said, we all know that the higher the leverage, the lower the cost of capital. But that's not always the case, and this is why I mentioned that it's actually a U curve when looking at the right capital structure. So too little debt in a business can be disastrous, and too much debt can also be disastrous. And an investor, so an equity investor or a debt investor, is trying to come and look at what is the right amount of each capital that is required for this business. The next thing on this is, if you look at the leverage ratios, we did mention that it has to be sector based. You need to benchmark, so businesses do need to benchmark with the industry standards of what each kind of business should be having as a leverage on their books. I'll move on to the next slide and hand over to Deepa to continue on some of the trickier issues on the shareholding structures and valuation.
Thank you, Sajan. So now, having looked at, sort of the balance sheet strength, the people, your comfortable market opportunity, you think it's there. So how does the deal get done? And this is what investors often look at. How easy or simple is the shareholder structure? Is it an individual? Is it a corporate structure? Do they structure the deal as a purchase of shares, or do they structure it as a purchase of business and assets? Do they invest 100%? So is someone looking to exit, or are they looking to sell a significant majority or a significant minority, or just have a JV partner, or have a partner who brings additional know-how, industry expertise, market expertise? So the deal structure that's eventually followed very much depends on the shareholder profile as well as what both parties are trying to do. Where there are several shareholders, the deal becomes harder to execute because it's more difficult for an investor to speak to so many people, and they may all be coming from different angles. They may all have different requirements for their own selves. And so to meet targets for each individual shareholder becomes difficult. And this is where then it's important for the group of shareholders to kind of set up a structure whereby maybe one person leads the group and one person speaks on behalf of the group. So they have sufficient time to deliberate on issues and come forth with one voice. And that's very important. Engagement with the major shareholders, how easy is it to do that? And sometimes it's not just about getting congruence with the major shareholders, because you can do that, you can do the deal, and thereafter you still have problems actually executing the deal or even running the company once the deal's been done, because you've not aligned the interests with minority shareholders that continue to stay in the business. So it's very important to look at the shareholder profile and look at it very thoroughly. And deals that involve supply side, where there are sort of small scale holder farmers or other stakeholders involved. Are we aligning their interests as well? And there may be sort of a wider beneficiary dialogue to be held there to get proper buy-in before a deal is done. Now, it is often very challenging because whilst the deal is being done, often there's confidentiality involved, and if there's a big group of other stakeholders, then how do you engage them? How do you make sure that following the deal there will not be issues around managing those stakeholders? Their interests will also be supported. So these are some of the factors that are very important and that a potential investor will always look at. Investors typically look for simple deals. They want deals that can be done straightforward. The people at the back of the deal are straightforward. So I think simplicity is the art of deal making. That's what my experience has taught me. And I believe that we should try and do our level best to bring forward a structure that is very simple prior to engaging in a deal. Next slide. So this slide, and it's kind of alluding to potentially a next webinar topic, but in terms of valuation, there are different valuation methods that can be followed. And the traditional ones are sort of doing a discounted cash flow or an asset-based valuation. So, with a discounted cash flow, it'd be looking at the future growth profile of the company and a suitable weighted average cost of capital, discounting the future cash flows to present day to come up with a value for the company. And then again, there you can explore various different growth scenarios, various different cost structures, and see how those impact the valuation methodology. And if it's an asset-based, especially real estate, would probably be more of an asset-based valuation together with, if it's a property that's on rent, then what are the rental incomes that are being derived from existing contracts? So those kind of aspects would be brought into the valuation. If it's an earnings basis, so especially where you're acquiring a minority stake at 30 to 40%, then the Gordon's dividend growth model is more important to look at. So various different methods. There's also, transaction comps. So what have previous transactions taken place at? What are the multiples that are going in that particular sector? If it's a TMT, then, what is your customer base? What is the average revenue per user? So a number of different factors are considered when it comes to the valuation method. The biggest challenge that we as deal makers have in this market is addressing the valuation gap. The buyer always wants to try to get the best deal and therefore lower the valuation. And the seller, especially in a situation where they're exiting, looking to keep a good or get a good return as they exit for the future, are trying to drive up the valuation. So the important aspect here is striking a balance on the valuation gap, looking at each party's interests. And it's not really about if there's a gap, let's split the difference. It's never about splitting the difference. It's about aligning the interests of the seller and the buyer, making sure the interests are aligned, making sure other factors are taken into consideration, such as synergies. And so negotiation of the correct value for the business is always from a point of interest of the various of both the parties, as well as the principles that guide in them wanting to do the deal. So what drives them to do the deal? And it's always very important to understand that, to ensure that both parties eventually are happy, or as some deal makers believe, that if for a successful deal to take place, the buyer will be a little bit unhappy and the seller will be a little bit unhappy. And that's the way to do the deal. So that brings us to the end of today's webinar in terms of formal content, but we're happy to address any Q&A that anybody has. And Chani will kind of lead us through that Q&A. But both myself, Sarjan, and Vincent are available for any Q&A. Thank you. And thank you very much for attending the webinar, and I hope it met your expectations. Thank you.
Thank you, Vincent, Deepa, and Sarjan for an insightful presentation on what truly captures an investor's eye in a business. Understanding what investors value is key to positioning your business for lasting success. It's more than just presenting strong financials or ambitious growth forecasts. Investors pay close attention to the leadership team, the clarity of your vision, and your approach to risk management. Ultimately, being investor ready is about telling a compelling story backed by solid fundamentals, thoughtful planning, and a capable team. We now have time for a few questions. We had a question from someone who was curious to know if they had all the financial statements, but they're just projections. So you basically have a business idea, but haven't started operations. How do you attract investors from this point? And which type of investors is best at this stage? Sarjan, you might want to take this and elaborate on your explanation.
Sure, thank you. No, so the question that has been asked is typically for what we call a startup business or a greenfield business. It's generally difficult for greenfield businesses that only have projections and have no history behind the business. It's a lot more difficult to get the financing, especially if you're looking for very large capital raise or have an very ambitious plan and have not tested the waters with the business, do not understand where the market is and what the likelihood of its success is. That's point one. Point two to understand is, yes, this is what a startup would look like when he has a business idea, who is looking for the initial capital to start, even probably just trying to do a prototype or a test or a pilot test. And this is where you're looking for now what we call pre-seed funding or seed funding. And this is where we get investors, equity investors on board. Look at yourselves, look at the business plan, and this typically comes in the form of friends and family, angel investors, very few VC funds that are able to come into pre-seed stage. Typically, the ticket sizes are not larger, but they do come in at that point. So what are they actually looking at? And when you look at a VC or any sort of VC, and a clear thing is, I mean, can you add Lions Den, and we've got Shark Tank globally and Dragons Den. And if you look at those investors and what they're looking at, they're trying to, besides understanding the fundamentals from a quantitative perspective, which are your financials, they're actually trying to get the right fit of character or the promoter. This is where the qualitative factors matter a lot more to them than the quantitative factors. And this is where we say that the matching of minds between the investor and the investee is a very crucial point. Do you have the same mindset? Do you have the same idea and same goals that the investors are looking at? They will also be looking at the sensibility of your business plan and your business idea. What are the products? How does the market look like it? Where do they see this market going? And do you have the same vision that this business can be scaled up from a smaller business to a much larger business? So that is what I meant when you talked about qualitative versus quantitative. So I hope I've answered your question on that.
Thank you, Sarjan. We have a few more questions. When you have two entities, same industry and directors or shareholdings, does goodwill arise if you merge into the other? And the next question is, do you think that investors' appetite and views are going to change with the current disruption in world trade order?
Wow. I'll take a stab at the first two questions before I give Deepa to provide her insights. So when you have two entities which are in the same industries, and the directors are the same, I mean, yes, there could be a case of goodwill, but how do you judge that goodwill? I mean, at the moment, if I get a question, if I understand this is the same business, same industry, same owners, pretty much they're cannibalizing themselves, right? So merging together creates a much larger entity for them. But the question will always remain on who the offtake or who their customers are. Are they two separate sets of customers? Are they still fighting the same customers? It wouldn't make a difference then, right? So I think there are a lot of factors that are involved to think of any goodwill that would come in. The idea that would have to be looked at, how does that cannibalization stop, and how do I make it into a much larger business to attract a much larger sort of outreach or demand for my products? So I think that needs to be understood, and then you could then see if there are synergies that do come in together, and there's a way that you would then efficiently run your business to increase your margins, possibility to have a goodwill. The question will always remain, how do you value that goodwill? On to the second question, with what's going on in the current world. I'm not much of a political person, but we've seen exactly what is happening globally with the disruptions. Is this a game that is being played, or is this a different type of world war that we're seeing? What I see from an investor, I mean, there's certain sectors and certain industries that are still favorable to investors. What's going to be very detrimental, what's going to be required or important for this is to understand how the trade wars are going to pretty much affect whether China is able to continue with its growth and expand its reach, its market reach. I mean, obviously a lot of the products did go to the US, but are they able to then mitigate? And you can see that they've been discussing with the EU. So the question here is going to remain on who is more at risk than the other. And then I mean, at the moment we don't see anything. We've not seen much of a change in the investment inflows into the region as yet, and I don't think there'll be much trouble in Africa, as I said, because I remember a lot of the products that are required for a lot of these manufacturing industries are found in Africa itself, especially with the new type of technology that we're looking at, and on the new type of manufacturing that's going on. So I would try to still be on the 50-50 side yet and watch and see what happens, but I'm hoping there's not going to be much change. Deepa, over to you for any other insights.
Yeah, maybe let me start with that second question and say that I think that so tariffs and all that is one thing, but we are witnessing a little bit of a sort of shift in political power, a shift in investment power as well. So traditionally, perhaps we've always had a foreign direct investment coming into the country from Europe and USA, whereas now perhaps Asia, Middle East, Asia including India, are becoming more popular in terms of pools of funding, Middle Eastern funding as well. And to an extent, these kind of investors that come from emerging markets who have experienced what we are only beginning to experience now in terms of growth in demographics and population have a lot to offer to companies that they'll invest in, because they come with a wealth of experience in understanding these companies and understanding how to drive growth in difficult environments, in competitive environments. So it's a good thing to that extent. And yes, we are seeing a little bit of a shift of power in terms of wealth, in terms of who is looking outside to invest. US with its current policies is perhaps going more inward than outward. And whether that will be for a period of 3 to 5 years or longer, that remains to be seen. But I think that there's a lot of opportunity in the current disrupted world trade order. And going back to the question of that particular scenario where there's sort of two entities, same industry, same director shareholding, I think that the key here is what was the reason for having maintained these two separately initially. So looking at that, building block or the core aspect, and have those reasons changed? What has changed to make it more viable now to merge the two entities? And to that extent, even if there's a goodwill, so who is going to pay the goodwill? Because it's the same shareholders. Instead, I would look at more a situation of, with the two entities merging, would there be better dividend payouts into the future? Whether it comes from retained earnings pre-merger, or retained earnings that are generated post-merger. And so I would look at it from that aspect, because who is going to pay the goodwill to, I mean, you can't pay goodwill to your own selves, right? So from that perspective. Now, where there's a third party investor coming in, then yes, maybe there's a goodwill aspect. But I think investors primarily, and this is going back to that valuation gap, investors are always looking into the future. They're always looking at what can I derive out of the business post money, right? And so they will, at the onset, always look at a valuation pre-money. And the pre-money valuation may not necessarily have goodwill in it. So I'll pause there, but happy to, have a separate dialogue at another point in time from the person who's asked that question. You have our contact details. Please do feel free to reach out to us, and we're happy to have a more, a deeper dialogue, knowing the specific situation that you're referring to.
Thank you, Deepa. Thank you, Sergeant, for the additional insights. I have one last question we could take before we close this. In your view, are there any specific challenges in deals involving heavily regulated businesses?
Let me take.
Yes, Deepa, please go ahead.
Let me grab a first stab at it, and then Sachin will chime in. So, regulated businesses, for example, banks. And given the banking industry, then the challenge there would be to sound out the Central Bank of Kenya or the central bank of the country in which you're doing the deal. And to that extent, before the deal actually goes public, maybe having on a no names basis, and this is where transaction advisors really do come in, because they can support you. And whether it's transaction advisors or legal advisors, they can come in to support, sounding out on a no names basis what that deal would look like. What are the regulators thinking? Because in a heavily regulated business, you also need to align your interests with what the regulator is thinking, how they're looking to grow that particular sector. Because at that level, it's not just about the companies that are doing this deal, it's about the entire sector. And the interests of the entire sector need to be aligned. So again, there are ways of sort of sounding out the deal ahead of official close so that you can anticipate the challenges and you can work out how best you're going to work with those challenges and take them forward. I hope that answers that question. But Sajid, any further points you'd like to add?
No, I think you've answered. And again, it's pretty much sector based. What's the outcome or what's the outlook of a particular sector? What is the sector trying to achieve? I mean, some other heavily regulated businesses, but if you're talking about tobacco and alcohol and the likes, obviously it's going to be very difficult to close a deal on those spaces because a lot of the funders, there's a very limited pool of funders or investors that would want to enter into that business. Your typical DFIs are definitely not going to be there and going to stay away. So there's certain regulated sectors of businesses that will find it challenging raising deals. And for them, it's the right idea is to look for a strategic investor who's already in that field and knows what this field is about, or a wealthy financial strategic financial investor that is not regulated, probably a high net worth individual that sees returns in this sort of a business. But yeah, I mean, when you're looking at the financial sector, then the insurance sectors, or obviously those regulated businesses, but you have seen quite a lot of deals happening in that space. But that's just based on outlook and how well those businesses are doing.
Thank you. Thank you once again to everyone who joined in today and to the speakers. As we wrap up today's session, I want to take a moment to thank you all for attending. Your participation and questions really helped deepen the conversation around strategic deal making. With that, I'd like to conclude today's webinar. And just to remind you that you can access the webinar recording on our YouTube channel, Video East Africa, alongside our previous webinars. Thank you once again.